Hey, Bulls and Bears, it's May 5th, 2022. Thank you for being here. The market's absolutely smashed. Today, S&P 500 down 3.5%, Dow Jones over 3%, NASDAQ, the big loser, down 5%, Russell 2000 down over 4%, oil up a little bit at almost 109. So what is happening? Well, there's been some mixed signals out there on where interest rates are headed and what the Fed may be doing or what they're going to be implementing down the road to fight inflation, right? So it's causing these big up days, these big down days. On one hand, markets are afraid of higher inflation. On the other hand, they're also concerned about rate hikes being too big. So we've said this before, going back several months now, years actually, the Fed's caught between a rock and a hard place. On one hand, they can't keep rates low because inflation is just skyrocketing wherever you look. On the other hand, there's so much debt out there. Everything is so leveraged. The bubbles are so inflated. If they raise rates too fast, you're going to cause a massive bursting of these bubbles. And there's many bubbles. Look at the housing market. Even the stock market's in a bubble. Debt is in a bubble. Debt's at a point where it's not much longer where people are going to be able to keep paying their minimum payments before bankruptcy comes knocking on the door. So something's got to change. It's got to be a crash, or it's just going to be a tsunami of defaults throughout the consumers that are in so much debt. Well, let's take a look at what's been happening here. There's been talks of a bigger rate hike. The Fed was out there talking about a 0.75 rate hike, and turns out they're signaling now just a half a point rate hike. So we'll see what happens with markets tomorrow. So it's pretty strange. The markets went from celebrating the Fed only talking about a 0.5% rate hike instead of a 0.75%, but then today came out with the complete opposite and decided to sell off based on the fears. Now, this rising cost of living and consumers getting into debt, it's not just a US thing, it's worldwide. In fact, the Bank of England just came out and said they're going to be raising interest rates now as they see inflation over there at 10%. Now, interest rates are at a 13-year high over there, according to the Bank of England. Now let's jump over to the housing market real quick here. We've spoken about the Canadian housing bubble, how it's much bigger than even the US housing bubble, much more detached from wages up in Canada than even here in the United States. Well, we're seeing Toronto home prices dropped the most in 2 years as higher interest rates in Canada slammed the housing market up there. Toronto, Canada home prices declined for the second straight month as Canada's largest city. Home prices dropped 6.4% in April from the month before. And that made up the biggest monthly drop since April 2020. But that was during the time of the lockdowns and the emergence of the health crisis. Now, over the past 2 years, the housing bubble grew enormously in Canada, a 50% rise in home prices just over the past couple years, driven partly by emergency low interest rates that were implemented to, quote, help the economy because of the emerging health crisis. What it actually did was let people borrow more money than they really should have been borrowing, and that inflated asset prices and home prices throughout Canada. We see something very similar here in the United States. Now, we've yet to see any major U.S. city have falling home prices, but it could be right around the corner if rates continue to rise and if the Fed continues the slowdown of the purchase of securities and mortgage-backed securities in particular. Now, something else that's pretty disturbing is happening, and that's small retailers especially are having a hard time paying rent. In fact, in April, 1/3 of retailers could not pay rent, and that's a troubling sign. With rising wholesale prices comes rising prices at retailers, and now consumers are starting to pull back on their spending. Yes, they're still spending a lot because prices are so high, but as far as the volume, we're starting to see a slowdown. And we see this report here out of Retail Dive. Now, the biggest contributors to this were the following: skyrocketing gas prices, transportation costs, supply chain issues, labor shortages, reduced revenues, and increasing rent. So the low commercial rents that we saw at the time of the health crisis have now reversed, and rents are on the rise for commercial spaces. And of the small businesses that were surveyed out of this report here, nearly half of them said rent was higher than just 6 months ago. And this is going to continue the trend of large multinational big box stores, mega corporations eating up bigger portions of the market when smaller businesses begin to fail, even worse than we're already seeing. One example, Walmart. Walmart paid $400 million in unanticipated supply chain costs in the fourth quarter of 2021, and that's more than the revenue of hundreds of smaller retailers combined. But yet Walmart still posted sales increases and healthy operating profits. Smaller companies typically have less money and less leverage with suppliers and carriers than the largest retail chains do. And this is yet another sign of much worse things to come here in 2022 for small businesses. And the less options you have as a consumer when smaller businesses close down, they can no longer make it. Then you have less options, and then the big players, they tend to increase prices even more because they know there's less competition out there for the goods, services, and products. Now, investor Peter Bukvar is out there saying that consumers are now at a breaking point as the Fed will fail to stop inflation. And this is another recent article. This one's out of CNBC. And this investor says, quote, "There's not much more consumers can withstand." He continues, quote, "It gets to the question, at what point does the consumer blink in the face of these rising prices? On the low-end consumer, they're already beginning to blink." Continues, "The consumer is going to call a timeout on spending because of the continued rise in prices. It's inevitable as price matters to the U.S. consumer who love discounts." Now, with consumers tapping the brakes on some spending, it's going to be very interesting to see how this plays out. I still think that entertainment, non-essentials are going to be the biggest hit. I think that food and necessities are going to continue to skyrocket. And I just want to continue to encourage everybody out there to do your due diligence, invest accordingly. Be careful, maybe stockpile some food, maybe think about it. I'm not giving advice here. Invest accordingly. I don't want to see anyone losing their retirement accounts or having their retirement accounts slashed by a large amount. Some people are losing big time because they were all invested in stocks. They thought the markets could only go up. Please let me know what you think down in comments on this one, folks. Are consumers getting tapped out? Are people starting to be more choosy and be more careful about what they're spending money on? Well, just a few reports ago, we talked about how a commenter down in this channel said that the amusement park was packed, so people still must have a lot of money. Well, if that's the case, then why is debt surging into all-time high territory and even further into all-time high debt territory? So a lot of this is just swiping cards and people spending money they don't have, but how long can that last? And interest rates are going up, the cost of everything is staying high and going higher. It's going to get pretty wild, folks, so continue to strap your seatbelts on. To hear from you down in the comments. Thanks, everybody, for being here. Peace now.